Hi guys, welcome to our morning session. This is Mr. Chauke. I'm a professional teacher of accounting, business studies, EMS, as well as research. If you're watching this, you're definitely at the right place. Please don't forget to hit that subscribe button down there, and I promise you that will make your accounting problems a thing of the past. Now, with that out of the way, let's get into the lesson. So here we are given some activity that we need to do so that we can be able to master our diminishing balance method. So here they're saying that balances appear in the books on 1 March 2020 as follows. Now remember guys, if our financial year starts on the 1st of March, it's going to end on the 28th of February 2021. So very important for us to be able to understand when does our year start and when does the year end. Okay, now here they're saying that at the beginning of the year we had equipment to the value of 40,000 and accumulated depreciation to the value of 7,600. Now when you do your depreciation guys, in grade 10 we separate it between the old and the new ones, because in grade 10 we don't sell our assets, we only sell in grade 11. So when you do this guys, be careful, make sure that you separate your depreciations in that way, so that you can be able to see whether you have calculated your depreciation for all the assets that you are given. So in order for me to be able to do that, I'm going to divide my answer sheet into two parts. This other side I will calculate depreciation for the new asset, and then this side I'll calculate depreciation for the old asset, which is the equipment that we had at the beginning of the year. Now remember guys, when we deal with the carrying value method, with diminishing balance method, you must firstly find out your carrying value, right? You must look for your carrying value, and then we know that our carrying value, it is made by taking the cost price and subtracting the accumulated depreciation. Because I don't have space, I'm going to write using acronyms, but if you're watching this lesson, I believe you'll be able to follow what this stands for. Okay, so before we do anything, that's what we need to check now. And also check the second one here. They're saying that a new equipment was bought for 96,000 on 1 November. You can look at the date. Here is the 1st of March, here is the 1st of November. So meaning that this new asset is not included here. You can also see in terms of the amount. So what we need to do is to get the carrying value. So our carrying value, remember we said it's going to be cost price minus accumulated depreciation. So for diminishing balance method, when you're dealing with an old asset, you must firstly get the carrying value first. Okay, so now we are going to say 40,000 subtract 7,600, and it's going to give us our carrying value. That carrying value that we are going to get, that's where we are going to calculate our depreciation. So if we say 40,000 minus 7,600, it is giving us 32,400. So our answer here is 32,400. Very important that guys, we make sure that we understand this. Okay, now we got the carrying value. Once we got the carrying value, then we can go and calculate the depreciation. Here they're saying that calculate depreciation on 28 February at 10% per annum on diminishing balance method. Remember, like I said, diminishing balance method, you look for the carrying value first. Okay, so we got the carrying value, then we need to calculate the depreciation. Remember, this old asset was with us for the entire year, so meaning that we are going to calculate it out of a period of 12 months, and our rate is 10%. So we're going to say 32,400 multiplied by 10 over 100 multiplied by 12 over 12, then it will tell us how much is that depreciation. So let's see how much. So if you say 32,400 multiplied by 10 divided by 100 and then multiply by 12 divided by 12, it's going to give you 3,240. So our depreciation for this asset is 3,240. Okay, so we got that depreciation that we were looking for. So you need to make sure that you master getting this depreciation so that you don't experience any problems with regards to this guys. Okay, now let's look at the new asset. The new asset, they said it was bought on the 1st of November, so meaning that it was only with us from November, December, January and February. So it was with us only for 4 months, and we know that the cost price is 96,000. This one will not have carrying value at the beginning, will not have accumulated depreciation. The carrying value will be the same as the cost price because this asset is still new. So our carrying value will be 96,000 in this case. So we'll say 96,000 multiplied by 10 over 100, and then also multiply by 4 over 12, and then it will tell us what is the depreciation for this. Okay, so we'd say 96,000 multiply by 10 divided by 100, and then multiply by 4 divided by 12. It is giving us 3,200. So meaning that the depreciation for this new equipment was 3,200. When you go to your income statement, assuming that this is the only asset that you have, the depreciation for the year will be the sum of 3,240 plus 3,200. And this is, guys, how you do depreciation using the diminishing balance method. I'll look for another for an example that has got a residual value, just so that you guys can see how these things can be a little bit different, but the principle will be the same. Remember, in terms of residual value, you make your carrying value to be 1 rand, and you check what is the maximum depreciation that you can get from that particular asset. Okay, so we are done with this part. If you need me to assist you with anything accounting related, you're more than welcome to get in touch with me by using the details that are available at the description of this video. With that out of the way, thank you so much, guys, for watching. May God richly bless you. Shalom. Dango.